Welcome back to Master Your Money and Mindset. I'm your host, Elizabeth Hiza, and today we are going to be talking about one of the most emotionally charged and often confusing parts of financial wellness, which is making decisions about your retirement savings. Now, this is a solo episode today, so I'm going to do my best to give you all 5 timeless rules that will help you make these smarter retirement decisions. Now, as always, Master Your Money listeners, you should be working with a financial professional. If you need a financial professional, please reach out to us. Our contact information is in the show notes. I could certainly get you in touch with a great one. If you currently are working with somebody already, you should, without a doubt, bring these questions to them. What I will be talking about is in generalities because I'm talking to such a great group of you, but it will at least help you be a little bit more educated about retirement. If you are early and you are really just trying to prep for retirement, this will certainly get you thinking. If you're butting yourself up against your retirement years, against that retirement date, these are questions that you should most certainly bring to your financial advisor. Again, if you need one, check out our show notes and I will definitely get you set up. For those of you who are working, if you have ever opened up your 401k portal and looked at the list of investment options and then quietly closed the tab like I typically do, this episode is for you because retirement planning can definitely feel overwhelming. But like I said, you should definitely work with a financial advisor, but there are things that you could do on your own just so you are more educated, just so you could open up that retirement portal and maybe not feel so intimidated. Maybe you could actually look at your retirement statement and feel comfortable that you know what you're looking at. But for any decisions that need to be made, please work with a professional. So again, today I'm going to break down 5 simple and timeless principles that can help anyone. So whether you're brand new to investing or you've been contributing for years, this will help you make better decisions, have more knowledge, and will help you feel more comfortable with your retirement accounts. Okay, so number 1, don't lose ground to inflation. So we all know what inflation is. It's when the cost of groceries, gas, electricity, all of our daily expenses feel higher than they used to be. But what many people don't realize is that inflation can also affect your retirement savings as well. So if your money grows at 4%, but inflation is running at 3 to 4%, which is pretty normal, you're really only gaining about 1%. And that's before your taxes. So that means 2 things are happening. First, you're going to have to save more than you think. So you should be increasing your 401k contribution every year, at least enough to keep up with inflation or with your annual raise. Those small increases will compound into big progress. So what this means is as you know, inflation is up and down, but your retirement contributions should not be set it and forget it. You should be looking at those at least a couple times a year to make sure that you are keeping up or beating inflation if you can, or even better, if you got an annual raise or a bonus of some sort, that you're contributing based on that versus you're contributing based on your income, not based on historically what you've always contributed. And second, not all of your investments protect your purchasing power. So cash alternatives like money market accounts sometimes feel safe, but over the long term, they lose value after inflation. So historically, the place where long-term investors have found the highest growth potential has been in the stock market. Now, yes, it fluctuates and that's so hard, which I understand. It's so hard for people to watch and it definitely feels scary, but over long periods of time, it has been a powerful engine for building wealth. So first tip, don't lose ground to inflation. Keep up with inflation. Make sure your contributions keep up with inflation. And 2, don't get nervous and pull that money out of the markets and put it into a money market account. That is definitely a decision you should talk to a financial professional about. Okay, second timeless rule is invest based on your time horizon. So your time horizon is just the number of years between today and when you plan to start using your money. So yes, you have to think out to a date, at least a year of when you think you want to retire. And then you work backwards to create your plan. And this matters because the longer your time horizon, the more ups and downs your portfolio can handle. So, for example, somebody who was planning to retire in 2008 most likely experienced the financial crisis very differently than someone who was still about 10 or 25 years away from retirement. Okay, so if you have decades ahead of you, you may be able to take on more growth-focused investments because you have time to recover from those dips. And historically, despite plenty of turbulence, plenty of up and down, the long-term direction of the market has been upwards. So think about your goals. If retirement is 30 years away, you may be able to invest for more growth. If retirement is right around the corner, you may want a more stable mix. Time certainly gives you flexibility. The longer you're invested, the more short-term noise tends to smooth out. But without a doubt, this is definitely a conversation you should have with a professional. But the point of this rule is to get yourself forward thinking enough so you have a rough retirement date in mind so you could start planning accordingly. Okay, so rule number 1, don't lose ground to inflation. Rule number 2, invest based on your time horizon. Rule number 3, consider your risk tolerance. So risk tolerance has 2 sides: your financial ability to take risks, meaning if you need your money soon, let's say you're about to retire, your portfolio cannot handle a big loss. You can't afford a big loss due to the market. If you are younger or if your time horizon is a little bit longer, and if you have other assets to rely on, you may be able to tolerate more volatility. When we talk about risk tolerance, you have your financial ability, which is essentially your portfolio combined with the number of years to retirement. But then we also have your emotional ability to take risks. And this is the most overlooked part of risk tolerance. If your investments keep you awake at night, this could be a problem for you. Many people think they're comfortable with risk until the market drops, and that discomfort becomes panic. Panic selling is one of the biggest long-term wealth killers. So be honest with yourself. How would you actually react if your account dropped 10% or even 20%? If you know you can't handle something like that, that is totally okay. It's just part of knowing your emotional risk tolerance. But there are ways to manage it. If you know your risk tolerance is low, there are ways to manage it. Always work with a financial professional. You guys are going to get annoyed with how many times I say this, but your first call should always be to your financial professional if you're feeling nervous. But other ways to help manage that emotional discomfort is to invest consistently because it spreads your purchases over time and reduces the pressure of timing the market. Number 2, understand what you own and why you own it. And then make sure you're diversified. So not one single investment controls your entire outcome. So everybody feels those emotions of the market. Everybody has an emotional risk tolerance. Now, of course, like everything, it's a spectrum. Some people are higher, some people are lower, but everybody sits on it. And obviously, the closer you get to that retirement age, the closer you get to needing that money, the more nervous everybody gets. So it's not about being completely fearless. It's about being realistic and protecting your peace of mind. But when we talk about a timeless strategy for retirement, you do have to give weight to both of those risk tolerances, both financial and emotional. So we have not losing ground to inflation. We have investing based on your time horizon. You are considering your risk tolerance. Rule number 4 is integrate retirement with your other goals. So retirement planning does not happen in a vacuum. It doesn't happen on its own. So before increasing your 401k contributions, like we talked about in rule number 2, make sure that all of your finances are buttoned up. So ask yourself, do I have an emergency fund set up? Do I have any high interest debt that's looming over me? Am I planning on making a major purchase soon? This matters because taking money out of a retirement plan before age 59 and a half can trigger taxes and a potential penalty. That is an expensive emergency fund. So build your foundation first. You need cash reserves. You need to be able to manage your debt. And if you do those things, then your retirement strategy becomes really strong. So if you ignore your emergency fund and you have an emergency, that's going to be a problem because then you're going to have to take that money out of your retirement fund, which could potentially cause fees for you, but also it's going to derail that strategy. So you want to make sure that your entire financial picture is in good, strong, stable shape before you go ahead and focus all your time and attention on retirement. Retirement is one piece of your financial goals, one piece of your financial picture, albeit a big one, but it is not the only piece. And you want to do everything you can to minimize any risk or mitigate any risk to that retirement strategy. And an emergency fund will help there. Being able to manage that high income debt will help there. Really being future focused and planning out any big major purchases will help protect that retirement nest egg that you're working so hard to build. So build your foundation first. And if your employer offers a match, make sure you're contributing enough to capture that because that's free money. So definitely don't leave that on the table. All right, we are on our last rule, but one of the most important. So number 1, don't lose ground to inflation. Number 2, invest based on your time horizon. Number 3, consider your risk tolerance, both financial and emotional. And number 4, integrate retirement with your other goals. And last but not least, our 5th timeless rule for a smarter retirement is don't put all of your eggs in one basket. It's an oldie, but a goodie. I know you have all heard this before, but it is truly one of the most important principles of investing. In the investing world, it's called diversification, but not putting all your eggs in one basket is really what it is. So different types of investments carry different risks. So stocks have market risk. Bonds have interest rate and credit risks. And international investments can add any other type of currency or potentially political risk. So any type of investment has some sort of risk attached to it. Because these risks behave differently, spreading your money across different types of investments can help balance your overall portfolio, which will contribute to your risk tolerance. This doesn't eliminate the risk entirely, of course, but it does help ensure that one bad moment in one part of the market does not derail your entire future and does not completely throw your plan off course, which again will also help with that emotional risk tolerance. So that is the heart of not putting all your eggs in one basket. That is the heart of diversification, which is truly balance, not perfection, because we know the markets and they are definitely not perfect. So I hope you found those 5 timeless tips helpful. You always want to keep it simple and stay consistent. So the big takeaway from all 5 of these principles is you don't need to outsmart the market. You just need a plan. You need to be consistent and you need time. And as always, you should be working with a financial professional, but you want to show up, you want to keep contributing, you want to stay diversified and let time be on your side, and your future self will always thank you. If you need support, if you need a financial professional to talk to, reach out in our show notes and we'll be happy to get you in touch with somebody. As always, thank you so much for joining me today on Master Your Money and Mindset. If this episode helped you feel more confident about your retirement planning, please share it with a friend or colleague. As always, I am here to help you build a healthier relationship with your money and the mindset to match it. Until next time, folks. Thank you for listening to Master Your Money and Mindset. You can find these episodes on YouTube or wherever you listen to your podcasts. Don't forget to like and subscribe if you enjoyed what you heard. You can follow Barnum Financial Group on LinkedIn and Instagram. Thanks so much.
All opinions expressed by the program participants are solely their current opinions and do not reflect the opinions their respective parent companies or affiliates or the companies with which the program participants are affiliated. Investments or strategies mentioned in this program may not be suitable for you, and you should make your own independent decision regarding them. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You should strongly consider seeking advice from your own investment advisor. Securities and investment advisory services offered through qualified registered representatives of MML Investor Services, LLC. Member SIPC, 6 Corporate Drive, Shelton, Connecticut, 06484, telephone number 203-513-6000.